April 14th meeting of the Senate Finance Committee will come to order. We will have two bills on the agenda today, both of them from Senator Kunesh. And the first bill is the E12 forecast adjustment, and this is a regular annual forecast adjustment that's required to update appropriations to match the current forecast. And they're made every year, and these areas, there are three of them actually. And these are areas of the budget that are forecasted, and therefore we have to adjust it to track the forecast. So this complies with the February forecast. Only difference, this year we're going to be putting the other forecast amendments in here. So this bill is going to be simply dealing with forecast adjustments. And there are, I think Senator Murphy has an A2 amendment to add the Metro Mobility and the Human Services ones to the bill. We've talked with the House, and they said they're probably, though they said it's unclear for sure, that they would probably have them in their separate omnibus bills, but we talked to them about the differences and are concerned they may not be passing all the omnibus bills, but they said, go ahead, do it your way, we'll do it ours, and we'll merge them together. And we are going to move forward on that basis. But with that, Senator Kunesh, if you want to welcome to the committee, and please go ahead and explain the education part.
Sure. Thank you, Mr. Chair. Senate File 4282 amends the E12 education appropriation that was enacted in the 2025 legislative session for fiscal years 26 and 27. And then it aligns with the February 26 forecast. The February 2026 forecast provides the most current official estimate of the amount of state aid necessary to fully fund statutory formulas under current law. The forecasted appropriation adjustments are typically the result of change in pupil counts, program participation, or actual costs. The appropriation changes are real, but the forecast adjustments have no trackable fiscal impact relative to the February 26 forecast baseline. And so the forecast adjustment under this bill provides the Department of Education with the necessary appropriation authority to ensure schools receive the full amount of state aid to which they are entitled under current law. And that is our education forecast bill.
Thank you. Mr. Nauman or Mr. Harnison have any additional things to add? Not at this point. Okay. And Senator Murphy, did you want to offer the A2 amendment?
Yeah, Mr. Chair, thank you. The A2 amendment is in your packets, members, and as Chair Marty described, it adds the forecast adjustments for the Department of Human Services, for the Department of Children, Youth, and Families, and for Metro Mobility.
And Senator Murphy offers the A2 amendment. Mr. Nauman, did you want to comment on this, and if there are any other areas where we ever have forecast adjustments?
So, Mr. Chair and members, the A2 amendment constitutes the bulk of what would be normally forecasted in any given year. The difference, as has already been alluded to or referenced in your comments and that of Senator Kunesh, is that in this particular case, similar to the 2024 session, a bill is being contemplated that would put all of the forecast adjustments into a single bill. In 2024 is the last time I recall this being done in this exact manner, where all forecasts are put together in the same bill, technical and non-trackable costs. The forecasts are handled a little bit differently in each budget area. So Article 1 strikes out and replaces the new appropriation values for the Department of Education. Members, I apologize for my voice. I picked up something over the weekend. Article 2 represents increments. So those dollar values are the exact appropriation authority changes. So you see there are increases in the Department of Human Services, but there are reductions in the Department of Children, Youth, and Families. And that just simply reflects the forecasted values from the current law forecast. in February and November. And then the transportation article for Metro Mobility, really this is the Met Council changes. And this is the first time we've done, as a legislature, the forecasted adjustments for Metro Mobility. This was a provision that was enacted in the 2021 legislative session to make Metro Mobility forecasted, but it had a little bit of a delayed forecast. And the changes are done as strikeout and replaces. So K-12 strikeout and replace, transportation strikeout and replace, and increments for children, youth, and families, and DHS. So, Mr. Chair, if there are questions, I'm happy to engage those.
Questions from the committee. Senator Draheim.
Thank you, Chair, and thank you, Mr. Nauman. My question has to do with the programs that have been frozen due to fraud, and how do we account for them, and were they accounted for in the forecast? I know housing support, some of those programs were froze from what I remember. So how do we handle that from a budget standpoint?
So, Mr. Chair and Senator Draheim, the best I can offer for you is that this is really a question for the Department of Management and Budget, how they manage the forecast. There are some details within the forecast, and we can have a presentation on those if you so choose. But fundamentally, what is being done here is that the forecast appropriations are being reflected, and the forecasted values and or the appropriation authority rather are being updated to reflect the actual forecast. So in most cases, I'm struggling to recall all the details. I think there were some choices that were made in the forecast. I didn't bring all my notes down for that, but what I can tell you is that we're updating appropriation authority for what MMB chose to forecast.
Senator Draheim. Senator Pratt.
Thank you, Mr. Chair. I am concerned with the process that we're going through on this. We've got almost $250 million in education spending. Admittedly, it's part of the forecast, and a lot of it, some of it is statutory, some of it is direct appropriations that we have committed to funding. But we have seen what happens when we try to put multiple areas together. Here we've got education, we've got human services, and we've got transportation all lumped into one. And while we may or may not have omnibus bills in each of these areas, it doesn't mean that we can't pass these forecast adjustments separately. In fact, I thought, Mr. Nauman, and maybe I'm mistaken, we haven't done this in this manner since 2004. Our current custom and practice has been to take these up separately.
Mr. Chair and Senator Pratt, I have some vivid memories of the 2004 circumstance that was put together on the floor of the Senate and sent to the House, and they accepted it. So I know that it happened that year. I can't speak definitively of whether it's happened since then.
To my point, Mr. Chair, this isn't our current custom and practice, and I think it sets a very bad precedent for how we do this. You and I spoke on Friday. We talked about the time it takes to pass a bill. Yesterday we did the prayer, the pledge, paper pushing, and 3 bills in 90 minutes. It can be done. These don't seem to be particularly controversial, but our Constitution does say that we should be taking up, single subject. It doesn't say take up single subject if time allows. It says we need to take up single subject bills, and this clearly is not single subject. I'm not arguing against any of the spending specifically, but it does complicate the matter when we've got an almost $1.7 billion bill in front of us that we can't take up these areas and have thoughtful discussion and debate on each one separately. So, Mr. Chair, I'm going to oppose the A2 amendment on custom and practice.
Senator Pratt, I would make the case that putting forecast adjustments into one bill I mean, if we wanted to, we could divide up and have every forecast adjustment for every program, but I don't think this has been an uncontroversial thing that's happened year after year. This is a smaller, single-subject bill which says it's the forecast adjustments. And so I think this is a much simpler way, and I'd rather we spend our time debating the substantive matters that deserve debate, where there's controversy over them. But I hear your point. I've talked this over with the House Ways and Means chairs, and I just think this is a fair way to do it. I don't object to doing it their way. Theirs is not, they're putting it into their presumably bigger omnibus bills. I don't know if they're going to do that or not, but that's what they were hoping to do. When we talked with them, we've suggested that they try and get through things anyway, especially bills that have been considered must-pass bills. They've been trying to get them through any way they can, and we're encouraging them to do that, and we're trying to get things through here. And I think we're both working with each other in different pathways to it, but I think it's a reasonable way to say all the forecast adjustments, which again is just putting things in line with the February forecast. I guess I just think that this is a reasonable thing to do. But I understand your objection to that, and is there any further discussion on the A2? If not, Senator Murphy moves the A2 amendment to Senate File 40.
Mr. Chair,
Senator Pratt.
may I request a roll call, please?
Sure. Roll call requested. On the A2 amendment, the staff will take the roll.
Senator Marty?
Aye.
Senator Friends? Senator Pratt? No. Senator Champion?
Aye.
Senator Draheim?
No.
Senator Howe? Senator Jasinski?
No.
Senator Johnson?
No.
Senator Mohammed?
Aye.
Senator Murphy?
Aye.
Senator Pappas?
Aye.
Senator Wickland? Senator Friends? Senator Howe? Senator Wickland?
There being 5 ayes and 4 nays, the motion does prevail. Is there further discussion on the Senate File 4282? If not, Senator Murphy moves that Senate File 4282 as amended be recommended pass. On that motion, all those in favor say aye. Aye. Opposed?
No.
Motion prevails. Senator, thank you, Mr. Anderson. Senator Kunesh, you might as well stay right there. You got the other bill. Constitutional amendment proposal to change the school permanent school trust fund investments and management and so on. Could you welcome to explain the bill now?
Sure. So good morning, everyone. I'm here to share with you a very pivotal piece of legislation, the Minnesota Senate File 3593, that stands to make a significant impact on our current education funding and the future of our students. As we consider this bill, I'd like to take a minute to touch on the legacy of the school trust fund and the vital role it plays in shaping the educational opportunities across our state. The Minnesota School Trust Fund was established upon our statehood in 1858 specifically to support the funding of our public schools and ensure that that funding is available for vital educational resources. This fund, excuse me, a product of our state's commitment to education, is fueled by revenue generated from state-owned lands and resources, specifically mining and timber, along with some of the usage fees. Over the years, it has become a constant source of our educational financing. Members, this fund has not been adjusted or touched since statehood. And so the biggest part of what this bill is doing is to modernize any outdated distribution formulas. It creates predictable and stable funding for schools. It protects the fund for future generations. Currently, the balance of this fund is $2.3 billion, and it has grown substantially over the last 10 years. Under the proposed language, the distribution would increase to 4.5% of the permanent school fund balance, which would result in an additional increase of $54.26 total, or total $122.15 per pupil. In 2026, the students this year were receiving $72.55. That's what they were receiving since statehood. That's the maximum we have received since then. And so that was just part of interest and dividends. This proposed bill would allow us to not only update the way those funds are being invested, but as I said, up to 4.5%, which would bring those students up to $122.15 with that portion of capital gains added to interest and dividends. And that is our bill.
Thank you.
If I might just,
Go ahead.
I want to just to read the statement that would be in the constitutional amendment,
Please.
because I think it's really important, and also make the point that this is no cost to the taxpayers. This is money into the general funds for our schools. And we know that no matter where we go across this beautiful state of ours, our schools are struggling for so many different reasons. But should this amendment go on to the ballot in November, the question submitted would be, shall the Minnesota Constitution be amended to increase the funding going to all school districts from the permanent school fund, which is a fund that supports school districts without raising individual income or property taxes, and it would become effective July 1st, 2027.
Thank you. And I'm told you have a technical A6 amendment as well?
Yes, I do have an A6, and it just clarifies some of the language around on page 2, and then in the last hearing that we heard, we had an amendment that increased that 4.5% to 5%. We are now, after careful discussion and review, going back to that 4.5%. This is the first time we've made this change in the permanent school funds, and we thought it was best to be a little bit prudent. Fortunately, we would have the option, should this pass, to make any adjustments going forward after careful, thoughtful financial consideration.
So in other words, and I know we have Representative State Board of Investment here, but in other words, if after this passes, 5 years from now, they think they could take 5% instead of 4.5%, they could do it statutorily,
Yep.
not through amending the Constitution.
Exactly. Yep.
Senator Murphy moves the A6 technical amendment. Is there a discussion on that? It's in the packets. If not, all
Mr. Chair?
Go ahead, Senator Pratt.
Thank you, Mr. Chair. My only concern with this is building in the administrative spending into this bill. Quite honestly, we should be covering that through the general fund, not through the school trust fund. But because we already have statutes around what that should be, and to me, this leaves it open-ended. I'd love to get some thoughts on what controls we have to make sure that, because we've complained in the past. When I first got here in the legislature, and Mr. Ernestson will probably have PTSD over this comment, but we always complained that there were too many expenses being taken out of the school trust fund, that there weren't enough monies getting back to the students, and I want to make sure that we don't run into that problem again.
And I understand the concern. I think this amendment isn't changing that, correct? You're just changing
Correct.
the way you're phrasing it, but the administrative costs under both the bill and this, okay. Is there further discussion on the A6 amendment? If not, all those in favor say aye. Aye. Opposed? Motion prevails. Senator, questions on the bill, and I understand SBI, State Board of Investments, here for questions and so on, and others as well. Okay.
Thank you, Chair. I guess, Senator Kunesh, the funding as proposed with the changes, my understanding now is that it's based per pupil. So my 33 little school districts in my district get the same as someone up here in St. Paul or Minneapolis. Is that correct?
Senator Kunesh,
Yes, that is correct.
Follow up? Yep.
continue.
Thank you, Chair. So Senator, the changes to the amendment, the constitutional amendment, will they still be based per pupil, or will there be some gray area for what changes with that? Are my kids still going to get the same amount per pupil?
Senator Kunesh.
Yep, your students absolutely will. And in the way that it's written now in that Constitution, it doesn't do the apportionment. It's not in the Constitution, so we have done it statutorily, and that has not changed. So every student will be receiving the same amount across the board.
Thank you.
Senator Pratt, then Senator Johnson.
Thank you, Mr. Chair. Mr. Chair, I'd like to offer the A7 amendment.
Senator Pratt offers the A7 amendment. I don't believe it's in the packet, so it has to be distributed.
And I'll apologize to Senator Kunesh. I haven't had a chance to talk to her. I'll be honest with you, I haven't been following this bill all that closely. And I'm hoping that this will meet the spirit of what Senator Kunesh is trying to accomplish.
Senator Pratt, you want to explain the amendment now it's been distributed?
Sure, Mr. Chair. The language in the bill says that the distributable amount shall equal 5% of the average net asset value of the permanent trust funds at the end of the preceding 3 years. Mr. Chair, we know that markets and returns go up and down year over year, and but our founders set this up for us as a permanent school trust fund, that we should be doing everything we can to preserve the principal and the value of that fund. So the changes here changes the flat 5% distribution to a must not exceed 5% as determined by the State Board of Investment, but with the restriction that no distribution should be made of any percentage if it would mean a decline in that school trust fund over the year. What we want to make sure is that the principal, the corpus of that fund remains whole, and that what we're distributing are the earnings and the gains from that fund, not the underlying asset value. And that is really the essence of it. So it sets its cap at 5%, but make sure that we're not dipping into the underlying asset value and depleting, putting the long-term sustainability of the fund at risk.
Senator Kunesh, thoughts?
I wish I would have had this earlier so that I could, confer with folks. So first of all, on your 1.5, that 5 is now going to be, as we propose, 4.5. So it would no longer be 5, it would be 4.5 in my bill. I'm hesitant to take this bill, or this amendment, until I really kind of fully understand. Right now, the market value of the fund is at $2.3 billion. And I feel like the amount that we are allocating already to our students is a pretty modest, pretty carefully calculated amount that would not dig into that 2.3 billion. We know that investments rise and fall, and over the last 10 years, I think this fund has more than doubled. And so I think there is some security in the investment that we have. And so without fully understanding how this would affect this bill or the ability to get the biggest bang for our return to our students, I think that I would pass on this one until I understand it better.
Mr. Chair.
Senator Pappas.
Mr. Chair, perhaps we could hear from the State Board of Investment. I know Ms. Schertz.
Yes, Director Schertz and Deputy Director Kunesh, come forward. Welcome to the committee, and please identify yourselves and go ahead and speak to it unless Senator Pappas had a specific question.
No, Mr. Chairman, just to respond to the amendment.
Thank you, Mr. Chair. For the record, my name is Jill Schertz. I'm the Executive Director and the Chief Investment Officer of the Minnesota State Board of Investment. Thank you for having us here today. Mr. Chair, Senator Pratt, first of all, I want to thank you for your question, and I'm going to share the microphone with my colleague. I'm going to lead it off and pass it over to him. I want to assure you that we actually spent a prolonged amount of time thinking about your very concern. Your concern is quite valid, and frankly, it goes to the heart of how we think about investment pools as fiduciaries. Our approach to this particular pool was to try to manage making sure that it was a perpetual vehicle that could balance the needs of current students with the future, which means two things at once. Making sure that we are providing adequate distributions for current students while making sure that this pool of capital endures throughout time. In analyzing many different approaches to this, we observed, and my colleague will expand on this, that the current approach in statute, or in the Constitution rather, actually echoes your proposal. And the issue with that is that it, by definition, favors the future over the current instead of balancing the two. In order to try to strike that balance, we did an in-depth review of like funds and endowments across the country to see how they balance these. And at the end of this, the task force concluded that best practice and frankly market was to arrive at a formula that provided the very safeguard you're proposing. And I'm going to turn it over to Mr. Kreck to introduce himself and talk about the task force work around that and why he has a level of confidence that what's being recommended is an appropriate approach.
Great.
Mr. Kunesh, go ahead.
Thank you, Chair. Members, my name is Andrew Kreck. I'm a Deputy Director with the State Board of Investment, and I was also a member of the Permanent School Fund Task Force. Some of the background that Jill was alluding to of the work that the task force did is we evaluated several different things. We looked at the historical performance of the investment portfolio of the Permanent School Fund. We identified that over a long period of time, the returns on the Permanent School Fund have been very strong. Over the last decade or so, they've averaged about 8% per year, which we feel is a strong track record of generating returns. However, we also evaluated the current legal and constitutional framework that governs distributions from the fund. We identified that the key limiting factor in the current legal framework is that distributions are limited in the Constitution to only interest and dividends earned by the trust. What that means is that capital gains experienced by the trust, a stock that the trust owns that increases in value, that increase in value cannot be realized or monetized, and those proceeds cannot be distributed to beneficiaries. And so the net result of that is that while the growth of the fund has been strong, the majority of that growth accrues perpetually for the benefit of future generations and not for the generations in the current day. One of the core principles that the task force identified was to better balance the needs of current and future beneficiaries while maintaining the trust as a perpetual financial resource, meaning that the trust must grow and preserve its purchasing power over time, over long periods of time, for the benefit of the students of future generations. Through the course of our work, we evaluated common practices at other similar school trusts around the country, as well as other educational endowments, think college and university endowments that have a similar mandate to the Minnesota Permanent School Fund. And what we observed is that the vast majority of those entities use a percentage of market value distribution mechanism, similar to what's being proposed by the task force and by this bill. The conclusion of the task force analyzing the situation of the permanent school fund and the research that was shared with us by our external and independent investment consultants and supported by work done in conjunction with SBI staff is that best practice of distributing a percentage of market value calculated over a trailing period of time, in this case 3 years, achieves a sustainable distribution model over long periods of time. We are taking a long time horizon and a long view with respect to this trust, given that it is intended to exist in perpetuity. One of the issues with the current construct in the Constitution, limiting distributions to interest and dividends, is that amount can fluctuate from year to year, and based on the loss recovery mechanism in the current legal framework, could result in distributions to districts going away entirely in certain years. One of the guiding principles that we identified through our work was seeking a solution to a distribution formula that allows for consistent distributions over time, while also allowing the trust to preserve its principle and grow, and preserve its purchasing power and grow over time. We believe that this mechanism, 4.5% calculated over a trailing 3 years, does achieve that objective over a long time horizon.
And I would just emphasize, to specifically address your concern, if I heard the description of the amendment correctly, we're really talking about, Senator Pratt, your proposal of a 1-year period versus the current mechanism is a 3-year period. And our analysis suggests that 3 years is an appropriate approach to try to address the concern you've identified and allows us to intervene if necessary in time to protect the fund, and over long periods of time results in the right balance.
Senator Pratt.
Thank you, Mr. Chair, and thank you for that. I appreciate it. A couple of concerns, right? First of all, I don't think I'm taking away the 3-year look. I'm just giving you the flexibility to go up to 5%. I agree with you. There need to be changes made, right? Because this is a fund that includes hard assets. We still have land that has an underlying intrinsic value, which is going to the net asset value of the fund, as well as cash assets that are being invested and getting returns. We're getting income off those lands from logging, mining, rental, whatever. And so I agree with you. I think, as we've sold land over time, that schools ought to benefit from some of those capital gains and be able to take those funds and invest them back in our schools. No doubt that there need to be changes. But the question is, this says there's no flexibility here. The distributable amount shall, which means must, which means you have to, no wiggle room, be 4.5% of the net asset value, including those non-cash assets. You have to include those into the distribution. So you're going to be depleting your investable funds over time. And what this says is that you may go up, and this says you may go up to 5%, right? I'd take it back up to the 5% of the net asset value, provided you've got the income to support it, but to make sure that the net asset value doesn't drop and that we are taking money away. So let's take the example, right? Let's say over the next 3 years, we see a 3.5% gain on investable assets. Okay, and I don't know what the split between investable and non-investable assets is, but let's say between your investment strategy and the income that's derived off the properties, we end up with 3.5–4% of that. We must, well, let's say 3.5. We must distribute 4.5 according to the A6 amendment, which means we're dipping into the investable funds that are in the portfolio. and we are depleting and putting the long-term stability, viability of that fund at risk. Whereas if we gave you the flexibility to decide what was right in order to maintain the underlying asset value of that fund, we would then ensure and preserve the viability of it going forward. Am I correct in that assessment?
Mr. Chair, Senator Pratt, thank you for that. I appreciate it. And I think I understand better your approach. I would say, I think the way I'm hearing it, there are two elements to your concerns and your recommended approach that I want to address. The first is, I think that your approach has a built-in fail-safe of a 1-year look back. If we don't make a certain return in a year, we can't distribute the next. Ours provides for a formula of a 3-year average. Our analysis strongly suggests that that's best practice and consistent with the great body of evidence of similarly situated funds across the country. You are absolutely right. We live with this every day across all of our portfolios. Markets are volatile. A 3-year period of time allows you to intervene soon enough, and at the same time, it allows your portfolio to perform without unduly restricting appropriate distributions. I want to address the second piece of the 5%, and this with sincere apologies for being rather conservative. We are, in our role as the SBI, and then I will say the task force role as having made the recommendation, we are strongly in support of a 4.5% upper limit, and not just an upper limit, but a fixed amount. A fixed amount because it provides predictability, and that's something that's missing right now. There has been an enormous amount of work to determine that 4.5%, based on the available analysis and looking at peer groups, is not only appropriate, but it is importantly a sustainable number. When the task force did its work, when it started this work several years ago, asset allocation studies at that time, particularly September 30th, I think it was 2024, indicated that an acceptable, potentially acceptable upper range, and I want to emphasize upper range, could be 5%. We are by our nature conservative people, and when we hear an upper range, we do get a little uncomfortable. I would also point out that those were based on capital markets assumptions 2 years ago. As the task force then performed their work to put together capital market assumptions, that number changed. That is why they concluded, based on appropriate capital market assumptions at the time of their analysis, that 4.5% was the appropriate number. It's appropriately conservative while building in a small margin of safety. I would also observe that as we think about what are the components of arriving at a 4.5%, it really is your view of potential investment returns, your view of inflation, importantly, your view of revenues from land management. And then how does that compare to the distribution rate you're suggesting? We anchored a 4.5% for many reasons, including, as I mentioned, the capital markets assumptions that have come down in the last 2 years, as well as, unlike some other states, if we look forward, we don't have, per se, an upward trajectory view on revenues from land management. In fact, you could argue they might be declining. So with that, we think that the prudent approach is to anchor to 4.5%, and that is, in fact, the task force recommendation as well as the SBI's.
Thank you, Mr. Chair. Well, Mr. Chair, what the amendment does is it preserves the school trust fund nest egg approach, which has always been the intent of the permanent school trust fund. In the current Constitution, it states the principle of the permanent school fund shall be perpetual and inviolate forever. All losses not offset by gains shall be repaid to the fund. And this bill deletes that language. It allows us to start dipping into the underlying asset value and puts the concept of being permanent at risk. Mr. Chair, I think this is a good amendment. And like I say, I apologize, Senator Kunesh, this kind of came to light late yesterday and I didn't get a chance to talk to you. And so, Mr. Chair, what I'm going to do is I'm going to withdraw the amendment. and talk to Senator Kunesh, and I'd love to have follow-up discussions with the State Board of Investment, because I am concerned that the hard and fast shall distribute a certain amount of the net asset value, because we are distributing liquid assets on the value of both hard and liquid assets. Puts the viability of that fund, because we don't know what the values of the lands are going to be. As you said, we don't know what the income stream off the lands are going to be. We can probably assume, forecast what the long-term gains are going to be on the investable assets more than we can what's going to be on the actual lands that are still in the portfolio. But because those illiquid assets are considered as part of the net asset value, I'm afraid that the long-term effect, I think this just puts a governor on it and allows the State Board of Investment to take a look to see if that 4.5% or 5% threshold is still the appropriate at any given time. I can certainly appreciate that we want to have more stability in the distribution of those funds. I agree that we need to update what funds are distributable. Absolutely agree, and our schools need that money, no doubt. But putting the underlying permanent school trust fund value at risk is not what our founders wanted to do, not why they set aside a section all over this. I can't remember, it wasn't a section per county, but it was a section per, I can't remember what the underlying was, but we ended up with, hundreds of sections of land in this that we've sold off over time and made investable. We've done a good job of managing that underlying asset. I want to see, as you mentioned, we're going to see inflation, right? If the underlying asset value remains at, just rounded off at $2 billion, and 30 years from now, the net asset value is still $2 billion, we failed. We have to keep up with inflation. Absolutely. But if we have a series of down years and we're distributing above what our gains are going to be, we're going to deplete this fund. Maybe not entirely, but once we lose those investable assets, they're extremely hard to get back, and we lose that compounding effect that our students and the viability of this fund rely on. So again, Mr. Chair, I'll withdraw the amendment. I'd like to keep this discussion going, and Senator Kunesh, I didn't mean to surprise you with this, and hopefully we can come to some sort of agreement.
Thank you.
Senator Pratt withdraws the A7 amendment. I have a question on that. So in effect, part of the discussion is, should we go with slightly more conservative but stable amount, so that you mentioned one of the purposes was to have it so people could rely on a fixed amount. And because obviously we can come back and change any of this in statute, but in effect, if it was 5, not exceeding 5 or 4.5%, in effect, you could go up or down with it. And your feeling is that the way you've been managing it and the way you would intend to continue managing it is such that it'll be more stable here. And if you see after 4 or 5 years that we could actually do more than 4.5, you do more. Is that the basic issue there? Because I think nobody wants the trust fund not to keep growing, but is that sort of the dispute, or what Senator Pratt's trying to bring in?
Mr. Chair, thank you. One, we would favor a fixed amount and a more conservative amount of 4.5 instead of 5. And both of you are correct that because this is in statute, should actual practice indicate that the fund can tolerate more over time, that would be a question for the legislature, and we would be here to provide our opinion as the fiduciaries. We look forward to further conversations. Thank you, Senator Pratt, for raising these issues, and we look forward to walking you through the safeguards that are embedded in the current proposals.
Okay, and in the other part of it is you would have, in effect, either we tell you you're going to distribute 4.5 or 5 or whatever percent, or if it was must not exceed 4.5 or 5%, then in effect, how would you change your management then? Would you then say, well, it's slipping a little bit, so we cut back, or?
Senator Marty, Mr. Chair, I think about this a little bit, how we think about managing pension assets for the combined funds. And again, when we think about those assets and our covenant that we have to pay benefits no matter what, we come to this with a very similar lens on our fiduciary duty and how important it is to preserve those assets in perpetuity. There's no forgiveness for missing that bogey. And in this case, the way that I would read the not to exceed versus a 4.5%, the task force did very in-depth analysis looking at many factors to conclude that 4.5% not only is a number that produces a balanced outcome, but that is in fact a number based on everything we know today and the safeguards we've built in that is sustainable over the long term. It also, from a portfolio management perspective, you know how you're managing the portfolio, what bogey you're trying to hit. I think that when you have a does not exceed, two things tend to happen depending on the makeup of the body, potentially. One, does not exceed means go to the maximum. Another could mean go to a floor. Neither may appropriately balance the needs of current students and future, and they would absolutely make managing the portfolio more challenging.
Is there, Senator Johnson, any discussion of the bill?
Thank you, Mr. Chair, and thank you, Senator Kunesh, for bringing this forward. I think this is an interesting discussion we have before us. You opened up your comments saying that we had not touched this fund since 1858 when the fund was initially established. When I hear that, I get a little concerned, because when you start looking at the way that our forefathers had established this fund itself, it really has been an asset for our schools and our state. And now there's a large pot of money that is sitting out there, which concerns me, because then politicians start looking at it and salivating that there's another opportunity to grab more money in the immediate, in the present tense, than worry about the future. And so when looking at the amendment and the amendment language that voters would be seeing, reading that, it sounds pretty rosy. It sounds like, should we be giving schools more money now? I don't think there'd be anybody that would vote against that. But what you forget to add in there is at the expense of our future students. And this has been a fund that is taking time to grow, but I think it's done a good job of establishing a corpus within it over time. It's been a long time that's been doing that, but it's been a very conservative investment strategy going forward. Things such as like 1.22 through 2.1, in which if there are losses, that the interest and dividends have to be paid back to the corpus in this to ensure that we're going to have a sustainable fund going forward. So here we are again, starting to mess with a fund to make sure that we can milk out as much as we can early on, and you say to balance, but I'm concerned that we are making this fund into something that will be more irrelevant in the future here going forward. We've doubled this fund in the last 10 years, has been stated here. If we were to do this scenario that we're talking about now, making the changes, doing the amendment, in that 10 years, do you know what the fund balance would be at the present? If we would go back 10 years and run the scenario of what we're discussing right now, what would the fund balance be in that fund?
Yes, Chair and Senator Johnson, that was part of the analysis that the task force engaged in with support of SBI staff. Perhaps not exactly the analysis that you're concluding, but we looked at what could we expect if the next 10 years or foreseeable future demonstrates similar return patterns and similar market performance as the last 10 years if we adopted this proposed distribution model. That is something that we evaluated, and we looked at scenarios where we envisioned the future largely looking like the past. We envisioned scenarios where market returns are somewhat more robust than we've experienced in the past. We also looked at scenarios where future returns are somewhat less than we've experienced in the past. So we tried to evaluate positive scenarios, negative scenarios, and a base case. And the conclusion that we reached, and we looked at a variety of different distribution formulas as part of that analysis, starting at 3% and gradually working up to 5%, and what would be the effect of different stops along the way in our analysis. And our conclusion was that the 4.5% distribution model in our base case, meaning the future looks largely like the past, the fund would grow moderately over that period of time, net of the distributions coming out of the fund. So we would expect that the fund balance would continue to grow from its current $2.3 billion over the next decade or so in a base case return assumption. It would grow substantially faster than that if returns are more robust than anticipated. And even in the scenario where returns are less favorable than we have experienced over the last decade, our expectation is that this distribution formula of 4.5% would result in negligible but positive growth for the fund. It would effectively retain its value over that period of time, even in a negative case. And that's part of the analysis that got the task force comfortable with this proposal of 4.5%.
Senator Johnson.
Thank you, Mr. Chair. So, Deputy Director, in this case, if we make these changes, then what we're saying is that the growth of the principal or the corpus of this investment, we're not going to see future growth like we have over the last 150 years in that fund. It's going to be more right around that $2.3 billion. The growth won't stay, we won't see the same growth as we've seen over the last 150 years.
Chair and Senator Johnson, I think in our base assumption, we would expect the rate of growth of the fund after distributing 4.5% to keep up with and exceed the rate of inflation. And so the real value of the fund, its purchasing power, our expectation is that it would be maintained and actually increase over time.
Mr. Chair, Senator Johnson, I think what you were picking up on was we always do a downside case. What if the next 10 years is not as attractive as the prior 10 years? And his response to that was the fund would still grow, even in a downside scenario, just not as robustly, which would also be true under the current approach.
Yeah.
Mr. Chair.
Senator Johnson.
And thank you for that, Director. What I'm concerned about is because of the conservative and prudent way that we've distributed funds and also maintained the corpus of this over the last, since 1858, is that we've been able to have a fund that's relevant right now and actually making some pretty substantial distributions to schools. What I'm concerned about is that if our growth rate doesn't continue to do that into the future, that over time, this is going to be basically an irrelevant fund as inflation takes over the next, if it's going to be the next 150 years or whatever it's going to be. All of a sudden, 2.1, 2.3, $3 billion, whatever it is, won't mean the same thing as it does today.
Mr. Chair, I do want to address, I think, what's an important point. The task force was not organized, nor is our mission as the SBI, to derive an outcome that maximizes distributions to schools. That may be a noble goal, but that was not, in fact, the task at hand. It was to find an appropriate best practices approach that would balance these present and future, but absolutely in all events, preserve and grow this fund into perpetuity. That is unchanged. And so I just want to be really clear that the exercise, had the analysis concluded that we could not increase distributions, we would not support, or put differently, if we could not support the growth of the fund, we would not support a 4.5% distribution. We would not support this change.
And Senator Johnson, in the constitutional language as proposed to be amended, it would require them to preserve the purchasing power of the fund over time. So in other words, it would be constitutionally bound to make sure it continues to grow. And they're saying grow the rate of effective inflation. In other words, it would be the value 30 years from now would be greater than it is now. But you're hoping, the whole point of your amendment is to make sure, this amendment is to make sure that you can give a stable and reliable amount to schools and allow it to continue to grow.
Yes, Mr. Chair.
I think that's, in other words, balancing how much they can maximize getting out now versus maximizing for future generations. And how long was the task force meeting? Was it a year?
Mr. Chair, we got together initially in September of 2024, and our report was delivered in January of 2026, so it was over a year.
Okay. Anything further, Senator Johnson? Senator Draheim.
Thank you, Chair. Capital gains. Yeah, I assume that's realized with the sale of assets like land. Is that correct? I just want to understand if we're including that, what does that all include? What types of capital gains are you referring to?
Yes, Chair and members, I'll clarify this, and this maybe gets to a comment that Senator Pratt made earlier. The $2.3 billion in the permanent school fund is entirely financial instruments. When we're referring to the fund, we are referring to a pool of investable assets that has been funded by revenues coming from the school trust lands. But the fund itself does not own the school trust lands, and they are not part of the value of the fund. So the fund, the $2.3 billion, is entirely stocks and bonds and some cash. It's invested according to an asset allocation that's monitored and maintained by the State Board of Investment. Right now, that's 50% stocks, 48% bonds, and 2% cash. And so when we talk about capital gains, we're talking about increase in unrealized value of those instruments over time. So the stock or the bond increases in value, but importantly, not realized. Because selling those instruments and monetizing that capital gain doesn't do the fund any real good, because those proceeds cannot be distributed to students, because the Constitution limits distributions only to interest income and to dividends. Does that answer your question?
Senator Draheim.
Yep, thank you. I just wanted to make sure that I was understanding it correctly.
Senator Jasinski.
Thank you, Mr. Chair, and I don't know if Senator or if Mr. Nauman updates this. My E12 education is a little, I've been on the E12 committee for a while, but so the State Board of Investment manages the PSF, and they give out the amount per student, $70. You said it's up from $40 5 years ago. So does that amount go up each year? Does it go up and down? Has it gone? What's the history of that student? I mean, it says it's up from 40 to 70, but does that go up and down, or does it just go up? Could you explain the fund that gets put out to the schools and how that's managed?
Sure. Chair and Senator Jasinski, I can address that. It has gone up or down over history. The amount of interest and dividends that are distributable from the fund is to some extent a function of the size of the fund. So as the fund grows, the number of shares of stock that the fund owns or can increase in value. But it's not that the growth rate of the fund, the experienced return on assets, is not directly related consistently to the interest and dividends that are distributable from the fund. Interest rates are the interest income that's received by the fund is a function of the prevailing interest rate environment in the general economy, and that changes over time, as I think we've all experienced over the last several years. Interest rates can go up and down, and so the distributable interest income from the fund can go up and down. And dividend income earned by owning shares of common stock can go up and down according with what is common corporate practice in the broader economy at any moment in time. And that has changed over time as well. If we go back multiple decades, the average dividend paid by owning a share of a U.S. stock was higher than it is today. And so that could change again in the future. And so it is subject to changes in market forces over time. It does not consistently always go up.
And thank you, Mr. Chair. Just one follow-up. So how does the school districts deal with going up and down? So they adjust their budgets each year based on this going up and down. So for 1 year, if it's $40, next year goes up to 50, then it goes down to 40 again. How is that impacting the school district? Are they having a difficult time with that? Do they usually obviously would like to see it go up each year, or at least budget for what that amount is? Because I know from a city budget, when you have increasing or steady and then all of a sudden it goes down, you have to make those adjustments. So going forward, is this anticipated to continue to go up and down? And how do the school districts adjust to that? Because again, once they have that steady stream and they see a decrease and they're being impacted by that, how does that affect how they're dealing with that? And again, with this bill, how would that change?
Sure.
Mr. Kresh.
Chair and members, I can address that, and perhaps, since I'm not a school budgeting expert, if there's others who want to chime in on that component, feel free. But one of our guiding principles with the task force was trying to achieve a solution in any recommended change to a distribution model that did not introduce more variability or more volatility in the distributable amounts to school districts than already exists. Recognizing the concern that you just expressed, that it must be challenging if you're determining the budget for a school district to not know what this component of your budget is going to look like. That is part of what guided us towards a recommendation of a consistent percentage of assets year to year and not a variable percentage of assets year to year. However, it is the case that because the investable assets of the fund are subject to market movements and are subject to market volatility, that the actual amounts in dollars distributed from the fund under this proposed distribution method would change year to year. They would go up when the market goes up, they would go down as the market goes down. But it's our belief that they would be relatively consistent and that the 3-year smoothing period, determining a distributable amount based on the trailing value of the fund over 3 years and not just at a point in time, helps moderate that variability in distributions over time. There would still be some variability in those distributions to districts year to year. So it would not completely solve the challenge that you've identified. But we did our best to try to recommend a solution that somewhat mitigates that risk. I'll also observe that the per pupil amount that's being distributed is not so large that it's going to be a very significant item in any individual district's budget. There were members of the task force who work in districts and at schools and in school finance, and that was the consistent feedback that we got from those members of the task force, that these dollars, while very important, are not representing a very large line item in an individual district's budget, and it's therefore easier for them to deal with and manage that variability in distribution year to year than if it were a much larger amount.
Thank you, Mr. Chair, and thank you.
Either two is from State Board, just so I have a sense of, you have the ability under this, if you think 4.5, if 10 years from now 4.5 is too low, you come back, ask the legislature to raise it, or opposite as well. Is it possible, if you look back 40 years, if your predecessors had this language, how often do you think they would come back to the legislature? Every 10 years? I mean, how often? I mean, you can't know going forward, but if you were in their shoes, would you have any clue how often you'd be coming back to the legislature?
Chair and members, I can try to address that. I think the short answer is as infrequently as possible. We would attempt to set a recommended distribution amount that we believe is sustainable over an extremely long time horizon. And it's based on evaluation of market behavior and forward-looking expectations that are quite long-term in nature. So our base case assumption would be that we should not be back here in 5 years or even 10 years suggesting a change. That said, markets can change, circumstances can change, the world can change, and so having that ability is good, but it would not be our expectation that we would frequently be requesting a change to this or recommending a change.
Thank you. Any further discussion with Senator Howe?
Thank you, Mr. Chair. And I got a couple of questions, and maybe it's already been answered, and I apologize for being a little late. First of all, how did we come up with the 3-year? I'm more normal that I'm usually seeing is, because I'm in the pension realm, is the 5 years. So we take the high 5 of somebody's income to establish their pension. Why did we set, and I would have to believe that 5-year downturn on a stock market is much more not apparent as we have had 3 years of downturn in a stock market situation. So why did we set on 3 instead of 5?
Yes, Chair and Senator Howe, I can address that. We evaluated a number of different possibilities in the task force work and supported by analysis provided to us by independent investment consultants that work with the State Board of Investment. And we believe that 3 years strikes a balance between a couple different interests. One, as we've alluded to in prior comments, a 3-year averaging period helps moderate the volatility of distributions from the fund, as opposed to doing a simple 1-year look back and just pegging the distribution amount to whatever the prior year's market value was. So it smooths and moderates the variability of distributions, which was a core principle that we were seeking to achieve. However, it also is a short enough period of time that it allows the fund and the distributions from the fund to be somewhat responsive to changes in the market environment. So if the stock market went through a dramatic decrease in value, a dramatic downturn in a recessionary environment, a 3-year look back would adjust the distributed amount downward more quickly than a 5-year look back. And so from our perspective, we viewed that as a protective element. It's a more conservative approach to take a shorter look back as it pertains to protecting the fund in a down market environment.
Senator Howe.
Thank you, Mr. Chair. The next question I got is, from my understanding, we're looking at possibly as much as a $54 increase or $124 per student. And I shouldn't do math while I'm sitting here talking because my math is my weakest component. But as we go forward, if we didn't do any of those changes, how long would it take the fund to distribute? How many years forward would it take it to distribute the same amount of money? How many years? Because we doubled it. We went from 40 to 70 in just a few years. Could we hit that 124 mark in just a few more years because the growth of the fund would be such that it would pay out the same amount in just a couple of years?
I can start that, and then I'm going to pass it back to my colleague. One thing that I would observe, Mr. Chair, Senator Howe, about the most recent investment period of time that we have experienced, under the current construct where part of your ability to pay out distributions is the interest and dividends, we have experienced a period of time that is, there are a few historical precedents where we've seen interest rates go from 0 to rise so dramatically. So there are really two parts of this fund's growth accelerating so much in the last few years. One, just market returns generally have been positive, but more importantly, interest rates going from 0 to in the 5s and 6s. And if you think about that, that by definition, created a larger distribution pattern. We know now that we're on the other side of that, most likely. If we had to guess, no one has a crystal ball, but the direction of travel is in the opposite direction. And as we look forward over the next 10 years, it is more logical to assume that interest rates actually decline, and therefore distributable amounts from the fund, even if the fund were to grow, distributable amounts are likely to decrease.
Nothing to add.
Senator Howe. Further discussion, Senator Pratt.
Thank you, Mr. Chair, and I think this has been a really good discussion. Director or Executive Director, there was a comment that was brought up, and I don't think we really talked about it all that well. In the new language, while preserving the purchasing power of the fund over time. That to me says that we're going to be looking at the real asset value. Well, first of all, I always thought the illiquid assets and the hard assets were part of the school trust fund, and I'll get back to that in a minute. But how are you going to be managing the real value versus the nominal value of the fund?
Yes, Chair and members, I can address that. So we would think about the investment. We would seek to construct a portfolio to invest the assets of the fund consistent with our forward-looking views on capital markets expectations for returns in stocks and bonds, the asset classes that the liquid assets of the fund, the $2.3 billion, are invested in, and with a view of long-term expected rate of inflation in the economy. And to be clear, that's an expectation. And it would be an estimate that we would evaluate and reevaluate over long periods of time. What we would not propose and are not proposing is to have an explicit tie to, for instance, year-on-year changes in the consumer price index or some distinct metric of that type. The approach that I've articulated is consistent with how the SBI manages all of our other pools of capital and thinks about asset allocation and implementation approaches. We think about long-term expected rate of inflation in the broader economy. I don't know if Executive Director Jill, do you have anything to say?
Thank you, Mr. Chair. Senator Pratt, I agree. We do take a building blocks approach to everything we do, as Mr. Kreck outlined. Inflation is a key component of that. So we're always thinking about we have to have a real rate of return, as you've appropriately indicated. I want to reiterate, and I understand your earlier comment about illiquid assets, and I want to assure you, picking up on something that Mr. Kreck has already mentioned, in this particular fund, even though a revenue stream comes from land management, there are no illiquid assets in this pool of capital, because we would agree with you. If there were, we would take a different approach. There would be a different analysis to this. But all assets in this fund are publicly traded liquid assets or cash, which again presents a different profile than if it were actually land itself in the fund.
Senator Pratt.
Thank you, Mr. Chair. And so where are those land assets managed then if they're not in the school trust fund?
Mr. Chair, Senator Pratt, we would probably defer to our colleagues at the Bureau of Land Management to answer those specific questions.
Where are the value?
My
Where's the
apologies,
value?
DNR.
Where's the value accounted for? Because there is an intrinsic value to those properties.
Yes, sir. They are not in the Permanent School Trust Fund.
Welcome to the committee. Please identify yourself and go ahead with the question.
Good morning, Mr. Chair, members. Senator Pratt, thanks for the question. Aaron Vandelin, School Trust Lands Director, and as Executive Director Schertz said, the school trust land assets are not considered part of their permanent school fund for their investment strategy on the investment side of it. I've always talked about it when I think about the school trust. I always think about the school trust having two assets. One of those assets is land and minerals assets. It's 2.5 million acres of a unified land and mineral estate and another 1 million acres of severed minerals. If you were to look at the entire portfolio of the school trust land, 2.3 is in a financial asset. The cash basis of that 2.3, based on what I see, is 1.1. 1.1 billion has come from our land management and minerals management since statehood. The remaining value of those 2.3 or 3.5 million acres is about $8 billion that's unrealized, including our minerals and our real estate. So the value of our fund would be, in total, $8 to $9 billion. I'm sorry, I misstated that. It's about $6 billion in minerals and real estate. So the total value of the fund is $8 billion, and Minnesota does not manage it, as you've heard before or already today. We do not manage our trust fund as a whole trust asset. That is not the concept that we manage under.
Senator Pratt, continue.
Thank you, Mr. Chair, and thank you, Mr. Vandal. I appreciate that. It's been a while since we've met. Mr. Chair, one of the concerns that I've heard, right, is if the 4.5% is not the right value, we'll come back to the legislature and we'll ask for a change. We're writing this into the Constitution. There is no ability to change this via statute.
Senator Pratt, the 4.5% would be in statute.
4.5% would be in statute. Sorry, I misunderstood that. Thank you.
Further discussion on the bill? If not, Senator Kunesh, do you want to speak to your bill?
Well, thank you very much for this robust conversation. Every time I go through this process, every time I meet with these folks, I learn so much about this incredibly valuable asset that we have. And I think all of the questions that you brought up were were really significant and very helpful, I think, for all of us to understand. And going forward, I'm thinking myself, I need to go back and re-listen to this and really understand the work that we're all doing. The questions, I think, were really spot on, and I have a whole page of notes here for myself now, too. So I would like you all just to consider the opportunity here to support and financially support our students here in Minnesota. I've sat on the School Trust Land Committee since I was in the House, so 10 years. And this is always something that has sort of plagued me, is like, why have we not looked at how we can best invest these dollars in this time and space? We're a little more sophisticated. We have incredible people here that are really vetted and very interested in making sure that we are getting the best return of investment, not just for the state of Minnesota, but also for our students here. And I would ask you to support this bill in order to get those dollars to our students the way that the founders of this state of Minnesota intended it to be.
Mr. Chair.
Senator Pratt.
Thank you, Mr. Chair. I move we lay Senate File 3593 on the table.
Senator Pratt moves that we lay Senate File 3593 on the table. The chair hopes this bill, by the way, this bill would be referred to Rules Committee next. But, and I would like this bill to keep moving. I think this is a positive step forward, and I urge people to reject it. But Senator Pratt has made that motion. Do we do a roll call on this? Is there further discussion on that motion? If not, I know, I asked for one. If not, the staff will take the roll.
Senator Marty?
No.
Senator Friends? Senator Pratt?
Yes.
Senator Champion?
No.
Senator Draheim?
Yes.
Senator Howe?
Yes.
Senator Jasinski?
Yes.
Senator Johnson?
Yes.
Senator Mohammed?
No.
Senator Murphy?
No.
Senator Pappas?
No.
Senator Wickland? Senator Friends?
No.
Senator Wickland?
There being 5 ayes and 6 nays, the motion does not prevail. Senator Pappas.
Thank you, Mr. Chairman. I would move that Senate File 3593 as amended be recommended to pass and sent to the Committee on Rules.
On that motion, is there further discussion? If not, staff, I will roll call on that one as well. Staff will take the roll on that one.
Senator Marty?
Aye.
Senator Friends?
Aye.
Senator Pratt? Aye. Senator Champion?
Aye.
Senator Draheim?
Aye.
Senator Howe?
Aye.
Senator Jasinski?
Aye.
Senator Johnson?
Aye.
Senator Mohammed?
Aye.
Senator Murphy?
Yes.
Senator Pappas?
Yes.
Senator Wickland? Senator Wickland?
There being 11 ayes and 0 nays, the motion does prevail, and Senator Kunesh, you and the Constitutional Amendment are on the way to the Rules Committee. Thank you and State Board of Investment Managers for being here as well. With that, real quickly, next week, I want committee members to be aware we're likely to meet every day as we begin to process the budget bills. And we'll be putting together the calendar for that right now, and else we'll send out calendar holds for the next week later today and follow up with schedule information as soon as we know. With that, this meeting is adjourned.